Mortgage rates are climbing again, and this time it's not even really about housing. It's global headlines, it's Iran, it's oil prices, and if you're a real estate investor, this is one of those moments where you either sit on the sidelines or you quietly position yourself to make money while everyone else freezes. Right now, mortgage rates have pushed back up into the mid 6% range, hitting near 4-week highs. And when most people hear that, they immediately think, bad time to buy. But that reaction is exactly why opportunity is starting to open up. Because what's actually happening behind the scenes is bigger than real estate. When tensions rise globally, especially involving a country like Iran, it can push oil prices higher. Higher oil prices can drive inflation fears, and when inflation fears go up, bond yields rise, and mortgage rates follow those bond yields. So by the time it hits the housing market, the average person just sees higher payments and gets scared. And when people get scared, they pause. Buyers step back. They say, I'm going to wait until rates come down. But here's the problem with that thinking. When everyone waits, demand drops instantly. Homes sit longer. Sellers who were confident just a few weeks ago start getting nervous. And that shift in emotion is where investors make their money. Because now, instead of competing with 10 buyers, you might be competing with 2 or none. Now, instead of bidding wars, you're having conversations. Now, instead of paying over asking, you're negotiating under market value. This is where you lean in, not back. If you understand what's happening, you start looking for properties that have been sitting on the market longer than usual. You start talking to sellers who expected their home to sell quickly, and now it hasn't. That's where flexibility shows up. Price reductions, concessions, creative deal structures. And this is where you separate yourself from the average buyer. Because the average buyer is focused on the monthly payment. An investor is focused on the deal. You start asking better questions. Can the seller carry financing? Can you assume their existing loan if it's at a lower rate? Can you partner with someone and structure the deal differently so you're not stuck with today's rates? Because the truth is, you don't have to play the game the way everyone else plays it. And here's another thing most people miss. Higher rates force discipline. When money is cheap, people buy anything and hope appreciation saves them. But when rates go up, only the strong deals make sense. That means if you're buying right now, you're probably buying smarter. You're focusing on cash flow. You're making sure the numbers work today, not 2 years from now. You're building a portfolio that can survive uncertainty, not just thrive in perfect conditions. And then there's the long game. Because what happens when rates eventually come back down? And they will at some point, maybe not tomorrow, maybe not next month, but cycles always shift. When rates drop, affordability improves. Buyers flood back into the market, demand spikes, and property values start climbing again. So if you bought during a time when everyone else was hesitant, you're now holding an asset that becomes more valuable as the market heats back up. That's how real wealth is built in real estate. Not by chasing the hottest market, but by stepping in when things feel uncertain. Right now, people are watching the news, hearing about Iran, seeing volatility, and assuming it's a bad time to move. But experienced investors are looking at the same information and thinking, this is where the leverage shifts. Because fear creates hesitation, and hesitation creates opportunity. So the question isn't, are rates high? The question is, how do I use this moment to my advantage? Because the people who figure that out are the ones who win when the market turns again.